We're back with another beginner series, and today we're going to talk about fixed indexed annuities. I'm going to go through a bunch of different features of a fixed indexed annuity, talk about when you would use them, how they're kind of used in the industry, and why they could be such a valuable portion of your overall retirement savings. So we're putting out a lot of content just like this every day. Go ahead and click the subscribe button if you haven't already, and give us a like on this video. Now that that's out of the way, let's get into the content here. So the first thing you want to think about with an indexed annuity is, well, why would I use one, right? So as you're accumulating your wealth, you may be in a position where you have an old 401k from a previous employer, or you're getting close to retirement age and you're not quite sure about everything that's going on in the market, and you're getting nervous around just the overall, hey, I've accumulated this, I don't want to lose it, right? But you also don't want to be sitting in the bank having that money earn next to nothing and actually losing money because of inflation. What an indexed annuity can do for you is kind of give you guardrails, right? They set a cap on how much you can earn, but they also set a floor on your loss potential. Generally, the floor is set at 0, meaning you can't lose money in that annuity, but in order to protect on the downside, they're going to give you a cap on the upside. So the way that they put those caps in place is really two different ways, right? There will be something called a cap rate, and that cap rate will be based on the index that your interest is credited from. So most people understand the S&P 500. A lot of these annuities have an S&P 500 index, and that S&P 500 index will have a floor of 0, like we just talked about, meaning if the S&P 500 drops 35 points, your account value stays exactly where it was. It doesn't lose 35%, right? But on the other hand, if the account goes up, the S&P 500 does 20%, 30%, they may cap you at 7, 8, 9, 10, 12, whatever that rate is, which is subject to change, that cap rate is where you'll be capped at. So, just in easy general terms, you have an account value that you start this year, and that measures point to point, meaning we start this year and next year we come around and we see how much that index did. If that index grew, up to your cap rate or more, you get credited the interest rate that is there, right, up to the cap. If it did less, if it did 5%, well, you get the full 5% because your cap was higher and you get up to that cap. If it did minus 15% for that year, your account value doesn't change. So you didn't lose any money. This is a way to keep you invested for the long term, right? Keep you invested, allow your money to grow, but not have to worry so much about what's happening in the market day to day. The next way insurance companies will credit on a market index is through something called a participation rate. So instead of capping you at a certain percentage, what they'll say is, we'll let you participate fully in that index up to a certain percentage. So it might be 65% or 75% or 100%. There's some participation rates that are above 100%, meaning, if you have 120% participation rate and the index returned 10% in that year, your interest credit is actually 12%, right? So there's a lot of different ways that these companies use to credit your interest. And it's important to start to understand that and really work with somebody that can help walk you through the ins and outs of the different fixed indexed annuities that you're looking at. To be clear, the way that a fixed indexed annuity works is your money is actually not invested in the market. What happens is that money is sitting in the general account of the insurance company. So because it's sitting in that general account and it's getting credited interest based on the market performance, That's why you're able to put that downside protection and not have to worry about that market dropping, because you're not actually invested in the market. A couple other things when it comes to fixed indexed annuities, right? By this point, you're probably understanding a little bit more about them and thinking, well, is this the right vehicle for me? If you've accumulated some wealth and you're worried about that wealth, it might make some sense to start looking at these types of products. If you're just starting off, the fixed indexed annuity is probably not for you, because a lot of these products are just a lump sum, right? Meaning I can only put a deposit in one time and I can't do any more after that one initial deposit. So they're not really meant for accumulation so much. They're really meant for, hey, I've got some money, now I want to do something with it, and I want to put guardrails around my investments and my wealth. The last piece you want to really understand about fixed indexed annuities is it's not just about the growth, but also the distribution. So there's many enhancements and riders that are put onto these. Some of those riders include income distribution, right? That's probably the biggest feature. Is, people are really using these to figure out, well, how much income can I get off of the dollars I accumulated, right? And I don't want to stop that growth. I want to continue to grow it for the next 5, 10, 15 years. But at some point, I need to start taking income. So there's income riders that you want to take a look at. And some of those may have fees associated with them. Most of these annuities have 0 fees associated with them. But the riders may come at a cost. You want to make sure that the benefits you're receiving obviously outweigh the cost of that rider. The last feature, right, we got income rider. A lot of times there's enhancements for long-term care situations. So long-term care is a big challenge for people as they get into their later years and in retirement. So covering those costs, there may be enhancements to double that income if you qualify for a long-term care event. So just other things to think about. And of course, we want to make sure that the costs aren't exorbitant in that. So working with somebody that really understands these annuities will be of big value to you when you're trying to decide, well, which one is the right one for me. And if you're looking for more information, we actually created a whole tutorial on the different types of annuities that are out there. In the description below, click the link and you can get free access to our course that really walks you through all the different types of annuities that are available for you.